All right, so diving in today, you guys have been asking for it, wanting to really get a grip on this whole house flipping thing.
Yeah, it's hot right now. Everyone wants to know.
And we're going deep today, like straight to the source.
Mhm.
We've got the experiences and advice of Anil Aggarwal. He's a seasoned flipper, been doing this for a while. So think of this as your cheat sheet. We're cutting through all the clutter to give you the need to know stuff, all based on what Anil has actually lived through in this business.
Exactly. We dug into Anil's personal story, how he got started, what hurdles he faced, and, of course, the core principles he swears by. Our mission today is to pull out those nuggets of gold for you, those aha moments, the stuff that really makes a difference without getting lost in a sea of information. We're aiming for a crystal clear understanding, focusing on the core of what makes for successful flipping, all straight from the horse's mouth, someone who's out there doing it.
Okay, let's rewind to the beginning. Anil's journey started back in 2018, and it's kind of a classic how I got started story, but with a pretty big dose of risk right out of the gate. He got offered a 50-50 partnership on a flip, which sounds great, but it came with a, not insignificant price tag of $100,000 upfront.
Yeah, 100 grand, which he says was, a significant chunk of change for him back then. What's super interesting is how he got his hands on that kind of cash. He pulled $100,000 from his 401k, and get this, just for like 2 months. That right there brings up a crucial question for anyone just starting out. How much financial risk are you actually comfortable with? And are you leveraging existing assets wisely or setting yourself up for potential trouble down the line?
That's a great point about the risks. Jumping into something like this, you've got to be prepared. And that first property flipped, it seems pretty straightforward. They bought it for $186,000, did a quick makeover, mostly just painting, and then sold it for $235,000. Didn't sound like a huge renovation project.
Right. It was more cosmetic. So after covering all the expenses, they ended up with a profit of $11,000 each. Now, I know $11,000 might not sound like a life-changing sum for some people, but for Anil, he describes it as a total game changer. It was proof that this business model could actually work. Not only did it bring a financial reward, but it gave him that crucial motivation to keep going, to pursue more projects. It really highlights how powerful that initial success can be.
It's like getting that first taste of victory, and you just want more. So building on that early win, Anil started to develop a framework, a set of core principles, things anyone looking to get into flipping needs to consider before jumping in, before even buying that first property. And the very first thing he stresses is knowing your market. This is more than just browsing listings, right?
Absolutely. Way more. When Anil talks about knowing your market, he's saying you have to really understand neighborhood comps. Comps meaning the recent sale prices of similar houses in the same area gives you a baseline. And he also highlights the importance of demand. Things like good schools, amenities, those factors drive demand. And a key point he makes is knowing your exit price. What can you realistically sell that renovated property for? Are prices going up in that neighborhood, or are they flat? Have recent sales involved price reductions, or have properties been on the market for longer than usual? These are things you got to look at.
It seems obvious, but I bet a lot of people get caught up in the excitement and just assume property values will keep rising. They think that'll save them if they overpay or their renovation costs balloon.
That's exactly the trap he warns against. Don't bank on future appreciation to rescue a bad deal. If your numbers don't add up based on the current market, hoping for some unexpected boom is a huge gamble. Ground your decisions in reality.
Makes sense. Don't count your chickens before they hatch, as they say. Now, the next big thing Anil emphasizes is a thorough physical survey, like getting a pro to inspect the property. He actually tells a story that really drives home why this step is non-negotiable.
Oh yeah, that story about the house that was perfect on the outside, but turned out to have a messed up cement slab. Classic example. It shows how easily serious problems can slip by someone without the right expertise. And those hidden issues, they can cost you big time, both in money and time. So the big question for anyone thinking about flipping, are you ready to invest the time and resources to thoroughly vet a property before you sign on the dotted line?
And it's not just shaky foundations we're talking about here. He also mentions things like hidden oil tanks lurking underground, which can be a huge liability, landlocked lots with access issues, or even bad soil. These are the kinds of things that can eat away at your profit or even make a property impossible to sell.
Exactly. One little oversight in that early assessment phase can turn into a massive headache later on. This highlights why detailed due diligence and getting a qualified inspector are so crucial. It's an investment that can save you in the long run.
So we've talked about knowing your market, inspecting the property. Now, Anil puts a lot of emphasis on building a solid team, but this isn't just about finding people who can do the work, right? It's about building real, trusting relationships.
Absolutely. He lists out the key players. You've got your contractors, laborers, HVAC guys, plumbers, electricians, even the township inspectors. And his point is, you need these folks to be dependable, people you can trust to do the job right. It goes beyond just cutting a check. Treat them with respect, pay them on time, and actually build those relationships. He even mentions doing small things like sending thank you notes or holiday cards. Think about it. Clear contracts, performance milestones, regular communication. That's how you build trust and accountability. It's that human element that can make a big difference in a business that could feel very transactional.
Little gestures go a long way. You know, if you hit a snag during a flip, those are the people who are more likely to bend over backwards for you if they feel valued.
No doubt. Having a reliable team can be the difference between a smooth, profitable flip and one that's a constant uphill battle. They become an extension of your own ability to get things done, to make your vision for the property a reality.
All right, shifting gears a bit now, and Neil dives into something less glamorous but super important, setting up the right business structure, specifically forming an LLC. So why is that such a crucial first step for someone starting out in flipping?
It all comes down to protection. Setting up an LLC shields your personal assets from any liabilities your flipping business might incur. It's a safety net. So if your business goes into debt or gets sued, your personal stuff, like your house, is generally protected. And he also stresses setting up a dedicated joint bank account. And here's the key: funding that account before buying the property. This keeps everything clean, transparent, and helps avoid disputes, especially if you have partners. Clear financial boundaries from the start.
It's like setting a solid foundation for your business. Keeps things organized, helps you avoid headaches later on.
Precisely. It's about approaching house flipping like a true business, not just some casual side hustle. Professional from day one.
All right, last but not least in his initial considerations, Anil talks about protecting yourself before you even invest a dime. He calls it the 4 Ds, factors that are pretty much out of our control. What are those exactly?
He's just talking about disease, death, delay in decisions, and destiny. It's a little sobering, sure, but realistic. Life throws curveballs and you need to be prepared. What's really interesting is how Anil proactively addresses these risks.
His strategy, at least the one he uses, is an indexed universal life insurance policy, or IUL. Can you unpack why he thinks this specific financial tool is so beneficial for someone in the flipping business?
Well, he describes it as a multi-pronged protection strategy. First, there's the death benefit. He mentions having a $1 million policy for his wife, which would provide crucial financial security for his family if something happened to him. Second, it covers him if he gets seriously ill. Third, it gives him the option to borrow against the policy's cash value, tax-free, which could come in handy for future investments or if unexpected expenses pop up. He also likes that it offers some flexibility and that its growth isn't directly tied to the stock market, which can provide peace of mind in a business that can be unpredictable. Now, keep in mind that financial instruments like these have their own complexities and fees, so it's important to do your research. See if it aligns with your financial goals and risk tolerance.
So it's not just about worst-case scenarios, it's also about creating some financial flexibility and security along the way.
Right. It's about taking a holistic approach to risk management, understanding that there are unknowns in life and business.
Now, in the second part of his insights, Anil gets into how someone listening to this, someone interested in flipping but maybe lacking experience or capital, could actually team up with him. He lays out 3 different ways to work together. The first one is being a private lender. How does that usually work?
In a nutshell, you're providing the money to fund one of his flip projects. He offers a guaranteed annual return of 7%. Importantly, he says your investment is secured. But what makes this especially appealing, especially for someone new to the game, is the mentoring aspect. He says he'll share real-time insights into the project as it happens. So you're learning while earning a return. That 7% guaranteed return, that's worth thinking about. How does that compare to other short-term investments in terms of risk and potential returns?
Yeah, it's like getting paid to learn.
Yeah.
And you've got the security of that guaranteed return. Sounds like a good way to dip your toes in the water if you have some capital but not a ton of experience.
For sure. It's a lower risk way to get exposure to the flipping world. You get to learn from a pro without taking on the full burden of running the whole project yourself.
The second option Anil presents is becoming a passive investor partner. What does that type of partnership usually look like?
Here, both Anil and the investor put up 50% of the capital for the flip. But the big difference is that Anil handles everything. Finding the property, managing the renovations, selling it. The investor is completely passive. They can keep their day job or whatever they're doing without the day-to-day grind of the flip. And in return for their 50%, they get 20% of the net profit. It's worth noting that profit shares can vary depending on the market, the project, the level of risk. Researching typical arrangements is always smart.
So it's completely hands-off for the partner. But he does mention that the investor could get a bigger cut of the profits, maybe even 30% under certain circumstances. What are those?
That extra profit share comes down to whether the investor is willing and able to help out with certain tasks. He gives examples like communicating with a contractor, helping source materials, or handling some logistics. So it adds a layer of flexibility. If you have the time and want to get more involved, you could potentially earn a higher return. It's about finding a balance between passive investment and active participation.
I like that. You can tailor your involvement based on your availability and what you want to get out of it. Now, the third option Anil talks about is becoming an active partner. So what does that kind of partnership entail?
This is the deepest level of involvement, also with a 50-50 split on the investment, just like the passive partnership. But there's a catch. To be an active partner, you have to have already completed at least 5 or 6 flips on your own. It's not for newbies. This is about 2 experienced people working as true equals, sharing all the responsibilities and decisions every step of the way, from buying the property to selling it.
So this is for someone who's already got some serious mileage under their belt, who's looking to join forces with another seasoned flipper.
Exactly. It's a major step up from passive investing. You need a proven track record and a desire to be fully involved. The goal is to combine skills, share the workload, and reap the rewards together as equals.
For anyone listening who might be interested in exploring these options with Anil or just wants to see what kind of projects he's been involved in, he mentions his website. What can they expect to find there?
He says his website, www.flippurchase.com, has a complete rundown of his past projects. You can see the properties he's flipped, often with before and after photos. It's a great way for potential lenders or partners to do their research, to see the scope and quality of his work. It's like a window into his track record and expertise. The website also probably has more details about the specific terms and processes for each of the ways you can work with them.
So as we wrap up our deep dive into Anil Aggarwal's approach to house flipping, what are the key takeaways you think our listeners should walk away with?
I think the big lessons here are that successful flipping, like what Anil has done, is about so much more than just buying low and selling high. It's about understanding the local market inside and out, being super thorough with inspections, building strong relationships with your team, having the right business